Hi students, our today's topic of discussion is factors influencing share prices. Let us see the factors one by one. First one, demand and supply. It's a normal factor. Demand and supply of securities influence price of securities in the market. If demand of securities more than the supply, prices of securities may increase. On the other hand, the demand of securities is less than the supply, prices of securities may fall. Next factor which influences is bank rate. In cases of lower bank rate, definitely there will be a lower interest rate. So the demand for funds would be higher and the demand for securities would be high. Whereas in case of high bank rate, high the interest rate, the demand for funds would be lower and therefore the demand for securities would be lower. So bank rate is the rate at which the banks lends to other banks, the RBI to commercial banks. Market players. The share market is dominated by bulls than bears, then the prices of securities would increase. On the other hand, if the bears are dominating the market, then the prices of securities would decline. Then dividend announcement. It's a return on investment for which the shareholders prefers investment. So here dividend acts as a signaling device for price movements. If companies announce dividends, generally share prices of those companies expected to increase. On the other hand, if the rate of dividend announced is less than what was expected by the investors, less than the expectation of the investors, then the prices may fall in the market. About management profile. It significantly influences the success of companies and it have an impact on share prices. If the management comprises of educated, experienced and successful track record, then the share prices would higher. And otherwise, if a company is taken over by management having poor reputation, then the share prices would fall. Trade cycle. It's cyclical fluctuation in the economic activity, boom and depression or recession. During boom, prices would be at their peak and during depression, they would be at the lowest prices. So share prices gradually increase during recovery condition and would fall during the conditions of recession. Speculation. Suppose speculators are more in the market than investors. In that case, our speculation is high in a stock, then the prices would be showing high fluctuations. Speculation is at low level, then fluctuations in share prices would be lower. Political factors. The ideology of the political party which is in power and policies of that government, how they maintain relations with other countries, that is bilateral and multilateral relations, influences the share price. Industrial relations. It means there is a smooth relationship between workers and management, then the productivity will be high, leading to better profits. It will reflect on the share prices which may increase. There is the industrial relations are not proper, it's poor, and frequent strikes and lockouts occur, then performance of the company will be poor, therefore share prices may fall. Stability of the government. When there is a stable government in a country, businessmen have a confidence to invest in new business and also they will go for expanding the new business and volume of operation which have results in high profits and consequently share prices would increase. In case of instability in the government, the investors have a fear and they don't want to take new investments. So production will fall and also share prices will fall. It's a cyclical effect. Then general market sentiments, how the mindset of the people. If there is optimism among players, market players, more buying would take place, which leads to increase in share prices. In case market players are pessimistic, then more selling would take place, which reflect in falling share prices. Actions of the institutional investors. So they are the major investors, institutional investors, such as mutual fund, investment trust, pension funds, etc. They have a large amount of funds at their disposal. When they start buying, share prices would increase, and when they prefer to sell, share prices may decline. Level of foreign investment, FIIs, foreign institutional investors, are playing a significant role in share price movements. If the level of foreign investment in market is high, it means more buying option of buying, then the prices may increase. If the FFI sells their investments, it reflects in market fall. Return offered by other investors. If the Indian markets are high, offer high returns, the foreign investors would invest in Indian markets. Demand for shares would increase and price rises. In case returns offered by India of other markets in other countries are attractive than Indian return on Indian investment, then institutional investors may shift to those markets. In such cases, when they sell in large quantities, prices may fall. Availability of credit. Then when the credit is available without much restriction, then investors should borrow and invest in the market, which rises the price of securities. In case of restricted credit or credits are curtailed, the borrowing would be less and the demand for shares would also be lower. Effective regulation. If the stock market is run in a transparent manner with effective regulator, then the investors would feel confident and therefore more buying would take place and share price may increase. But when the regulation is ineffective and if scam occurs in a share market, investors would lose confidence and prices would fall.